According to a study published by UBS, Munich ranks worldwide number 2 of cities with highest bubble risk indicator. Congratulations! The potential of a bubble is driven by a context of very low interest rates. Does this mean that we are currently in a bubble? Not necessarily, but the risk is high, and here is why. In the euro area, people, firms, and the public sector tend to save money and pay off their debt because the debt ratio is high. If everyone saves money, prices go down. To avoid a deflation, the central bank reacts by lowering the interest rates so that saving becomes less attractive and borrowing more affordable. This has already happened in the past, for example after the internet bubble or after the crisis of 2008. The main refinancing operation rate of the ECB has been at 0% for years, and the central bank took some additional action to pump money into the economy. This has an impact on long-term rates of credit-worthy borrowers like the German federal government, and this also affects the mortgage rates. Short-term and long-term rates don't evolve simultaneously, but they are correlated anyway. So, people can afford more easily to borrow money to buy a flat, and they do so. Because of this, home prices rise, and this makes the rental yield lower. In Munich, you can see some flats being sold with a rental yield lower than 2%. This is because the population grows and the market expects higher rental prices in the near future. But what would happen if the economy gets better in the Eurozone in the next years or decades? Then, people might spend more money, which would make consumer prices higher. If so, the central bank will try to prevent a too high inflation by tightening its balance and making higher interest rates. Then, mortgages will be more expensive and safe interest rates will yield more money. So, there is a risk that people can't afford a mortgage anymore and stop buying flats with a low rental yield. They can decide to put their money into some other kinds of saving account. Is it a problem? If this happens within a long period of time, the increase of rental income can compensate or even outperform the increase of yields. However, if this happens in a too short period of time, flats can go down in value in a way that reminds some former real estate bubbles. How probable is this scenario? Who knows? Because the low interest rates are the result of a high level of debt, the question is to know how fast countries in the Eurozone can reduce their debt burden. By measuring the difference between long-term and short-term interest rates, we can see what the market expectation is. Usually, the yield curve is normal-shaped, which means that rates are higher on the long term than on the short term. In this case, the yield difference is positive. Sometimes the yield difference is negative, and this is often seen as a sign for an economic recession. Currently, we see that the difference is already low. So, a small increase in short-term rates would have a significant effect on long-term rates and therefore also on mortgages. If you can save money at 3% and borrow money at 4%, why would you take more risk and buy a flat with only 2 or 3% rental yield? Maybe some people would do it to protect themselves against inflation. However, it does not mean that the whole market will do the same. If people stop buying homes, prices will eventually go down. So, interest rates are a real risk for the housing market in Munich. How can you protect yourself? You cannot do anything against a drop of prices, so you cannot repair a broken investment. But if you fix the interest rate of your mortgage for a long period of time, and if you pay it off quickly, you may avoid problems when you have to refinance it. Thank you.